The more you earn, the smarter your mistakes look. That's the uncomfortable truth about being a 500K plus earner. Your mistakes don't look like overspending. They look like a 401K you're maxing, an equity grant you're holding, and a tax bill you're still surprised by every April. They look rational. They feel fine in the moment, but quietly, they're building the type of structural fragility that shows up at the worst possible time. Today, I'm going to walk you through 13 of them. And if you're honest with yourself, you're probably guilty of at least 3 of them right now. I know because when I was a corporate executive, I made many of these same mistakes myself. Now, let me be clear. This video is not about budgeting. It's not about cutting back or spending less than you make. You know how to manage cash flow. What I'm talking about today is structural. The traps built into high income, highly complex financial lives that feel like they're working until suddenly they're not. I work with executives and business owners navigating serious equity compensation, real tax exposure, and careers at their peak. And these are the patterns I see over and over. Not isolated mistakes, structural ones. The kind that once you see them, you can't unsee. Now let's go through all 13. We'll start with the one that's underneath everything else. The income identity trap is when you build your entire financial life around the assumption that the comp machine keeps running. Big W-2, bonus, RSUs vesting quarterly, strong cash flow. Then life expands to meet that income. Home, schools, lifestyle, fixed commitments. And it feels fine because you can always earn your way out of anything until a reorg happens, a burnout happens, an industry cycle turns. The problem isn't the income. It's that income is not the same as security. Liquidity is security. Diversification is security. Tax structure is security. Here's the diagnostic question I ask every executive that we work with. If your income went to 0 for 12 months, what breaks first? Your tax obligations, your mortgage, your kids' school commitments, your lifestyle overhead? That answer tells you exactly where your real financial risk lives. The shift is from how much do I earn to how resilient is my balance sheet. I call that work optional resilience. Your ability to absorb shocks without being forced into bad decisions. Now that's the foundation. Everything else we're going to discuss today builds on top of that. And if you couldn't answer that question cleanly, the first place to look is your tax structure. And I put together a guide on exactly how to think about this for 500K plus earners. It's called the Executive's Guide to Tax Control in 2026 and Beyond. The link is in the description. It's free, and it takes about 20 minutes to review. Now, at 500K plus, your taxes cannot be just an annual task. They're your single largest controllable expense and the biggest place where sophisticated mistakes hide. Let's go through 5 of them. Every year, intelligent executives get surprised by 6-figure tax bills, not because they did something wrong, but because withholding at work doesn't work the way that most people assume it does. Employers withhold supplemental wages, but for income like bonuses and RSUs, they often withhold at a much lower rate than your actual marginal rate. If you're already in a higher federal bracket and you stack a large vesting event on top of an already strong W-2 and bonus year, the withholding leaves a real gap. Add in state taxes, and April stops being a filing exercise and starts being a high-stress financial event. The diagnostic question here is, have you made a 6-figure tax surprise in the last 3 years? If the answer is yes, then this trap is active in your situation right now. The fix is a proactive withholding and estimated tax plan tied to your actual compensation calendar, not whatever your employer's default settings say. Now, maxing out your 401k is necessary, but at 500K plus, it's nowhere near sufficient. The employee deferral limit in 2026 is $24,500, higher for individuals over 50 with a catch-up contribution. That is a fraction of your income and tax exposure. And over-focusing on the 401k can often create a false sense of progress. The real question is, what's your complete tax advantage toolkit? Asset location across account types, after-tax and Roth contributions inside your company plan, deferred compensation evaluation, charitable planning vehicles, and a multi-year tax projection that goes beyond this year's contributions. If your 401k disappeared tomorrow and your tax strategy barely changed, that's the trap. Most executives hold the same investments everywhere. Taxable account, pre-tax account, Roth, hold rollovers, without regard for how each account type taxes each investment differently. At lower income levels, this is inefficient. At 500K plus, it compounds into real drag year after year. Here's why. You're not just in a high marginal bracket. You may be subject to net investment income tax, an additional 3.8% on investment income above threshold levels, along with the additional Medicare tax on earned income. Different investments have meaningfully different tax profiles. Tax inefficient holdings sitting in taxable accounts cost you more than they need to. The mental model we use is simple. Every investment should have an optimal home. Assign it to the account type that minimizes its tax drag over your projected holding period. Ask yourself this. Can you explain right now why each major holding sits in the account that it sits in? If the answer is, it just ended up there, well, that's a gap worth closing. The result, executives accidentally stack multiple high income events into the same tax year. You create peak marginal rate exposure in a year that already had a promotion bump. You hold concentrated stock from multiple vest cycles because each one felt like not the right time to sell. Meanwhile, your tax bracket and your concentration risk are both quietly climbing. The fix is an equity compensation calendar, a single view of every vest, exercise window, trading blackout, and tax event, all integrated into a multi-year tax projection. And then you set default rules: when you sell automatically, when you hold, and how to diversify at each event. Rules remove the emotion from decisions that have real dollar consequences. Now, here's a question for you. If your company's stock dropped 40% tomorrow, would it affect your retirement timeline or your family's lifestyle in the next 12 months? If the answer is yes, then that's not an investment. That's a concentrated risk that you haven't quantified yet. If your CPA's involvement in your financial life is only between February and April, you don't have tax planning. You have tax filing. Most CPAs are primarily incentivized toward accuracy and compliance, getting the return right. Proactive planning, like harvesting losses, timing income, modeling Roth conversions, executing charitable strategies, requires a different kind of engagement at a different time of year. At high income, there are specific windows for specific decisions in every quarter, but by April, those decisions already need to be done. So here's a diagnostic question. Do you have a projected total tax for this year within a reasonable range right now? If not, there's no way to make proactive decisions. The rhythm I recommend is a quarterly tax check-in. Project the full year, identify gaps, and execute strategies before the window closes. These next traps get less attention. They're often slower moving, but they're also the ones that tend to create the greatest regret later. Your paycheck comes from the same company where your net worth is highly concentrated. And if the company struggles, you're hit twice: career disruption and portfolio decline at the same time. I believe in the company is a conviction, but it's not a diversification strategy. The fix is pre-committing to a diversification strategy before emotion enters the equation. Most executives already know they're too concentrated. The work is building a system that moves capital out of that concentration consistently and tax efficiently. High earners don't overspend, they overcommit. The bigger home with higher carrying costs, the private school tuition contracts, the second home with a fixed annual operating burden. Each decision felt manageable in isolation, but together they raise your must-keep earning number significantly, often without you realizing the compound effect until you're thinking about stepping back. The question isn't whether you can afford these things. It's whether these fixed commitments are buying you a better life or quietly extending the career that you're trying to transition away from. Design your spending intentionally. Increase joy, not fixed burn. Protect your savings rate and flexibility before upgrading fixed obligations. This one shows up constantly. One big portfolio trying to do everything at once. Pay this year's tax bill. Fund tuition starting in 4 years. Take care of the kitchen renovation. Cover near-term lifestyle spending, and somehow also aggressively fund a long-term retirement. One portfolio cannot hold all of these jobs without creating conflict. The fix is separating capital into time bands. I like to use 4. 0 to 2 years, your current needs. 3 to 5 years, your short-term goals. 6 to 10 is midterm goals, and 10 plus is long-term compounding. When money is matched to when you actually need it, you stop having to sell long-term investments to fund short-term needs. That's not just better math. It's the difference between staying fully invested during a down market and selling at the bottom because you had no other option. Most executives drafted their estate documents after their first or second child was born in a different state before the equity, the promotions, and the deferred compensation came. In many cases, the will hasn't been reviewed and the trust has not been updated with current assets. The beneficiary designations on retirement accounts and life insurance are probably still pointing to whoever they named over a decade ago. At this income and complexity level, your estate changes fast. If something happened to you this week, would you be confident that everything is clean and current? Estate planning needs to be a living system, not a one-time filing that sits in the drawer. Here are some life events that should trigger you to review your estate plan: a job change, a new equity grant, a major asset purchase, or any type of big family change. If you can't clearly explain what you pay, who gets paid, and what specific outcome you got from it, that's a problem. Complex financial products with high embedded fees, surrender schedules, and producer incentives show up in high-income financial plans much more than they should. Here are some governance questions to ask any financial advisor. What's your compensation model? Are there any conflicts of interest? And are you held to a fiduciary standard? And what specific decisions are better as a result of our relationship? And if those answers are vague, well, then you have your answer. Outsourcing your financial decisions to skilled professionals is smart. Outsourcing them without any framework to evaluate the results is not. You can delegate execution, but you can't abdicate oversight. Think of it like running a business. You have people responsible for different functions, but you still understand the numbers. Your financial dashboard should give you, at minimum, your net worth trend and liquidity runway, upcoming equity and tax events, concentration exposure, time horizon bucket alignment, and a one-page annual strategy that you can articulate in 5 minutes. And here's the real test. If your advisor left tomorrow, can you explain your strategy clearly? If not, you're a passenger right now, not a driver. This is the most common trap that I see. After the next busy season, after the next promotion, after the next liquidity event, I'll put a real system together. And every delay allows complexity to compound. More vesting events, more tax decisions, more accounts, more drift between your financial world and your actual life goals. There's never a right time. There's only a cost of waiting versus a benefit of starting. The most useful question to cut through this: what's the most unavoidable decision in the next 90 days? And do you have a clear plan for it? If you can't answer that, well, the system isn't there yet. Okay, let's bring this together. If you're earning $500K or more, the biggest risks to your financial freedom aren't market crashes or bad luck. They're structural: tax timing, equity concentration, withholding gaps, lifestyle lock-in, no governance, a portfolio with no time horizon design. Most of these traps don't announce themselves. They build quietly, and they cost the most in the years where you can least afford to absorb the hit. The goal isn't to fix all 13 overnight. The goal is to understand which ones are active in your situation right now, so that you can build a system that addresses them in order. And if you want to identify which of these traps are live in your specific financial situation, well, that's exactly what a free wealth strategy call is designed to do. It's not a pitch. It's an open conversation with me about your accounts, your tax exposure, and what a real plan to get to work optional looks like for you in real numbers. The link to book the call is in the description. And if this video is useful, subscribe. I put out content specifically for executives navigating complex compensation and real financial decisions every week. I'll see you in the next one.